This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The last bit of the arithmetic on discounted cash flow is annuities and perpetuities. And so in this lecture, let me go through them. First of all, an annuity. What we mean by an annuity is an equal amount, an equal cash flow each year. And so to explain exactly what I mean and how we deal with it, look at example 4. A machine will cost 45,000 and is expected to generate 8,000 a year for each of the following 8 years. The cost of capital is 15% a year. Calculate the NPV. Now, you could actually do it exactly the same way as we have been doing in the previous lectures. You know, there's an outflow of 45,000, the cost of the machine. We've then got an inflow of 8,000 a year for 8 years. So 8,000 in 1 year, 8,000 in 2 years, in 3 years, and so on. And just like before, you could use the tables and discount each flow individually. And so, if I can find my present value tables, here the cost of capital is 15%, so the discount factors at 15%. 45,000 is 45,000. But from then on, for 50% for 1 year, it's 0.87. For 2 years, 0.756. 3 years, 0.658, and so on. Now, you could do that, and it's not hard, but it obviously takes time. And because it's an equal amount each year, instead of multiplying 8,000 by 0.87, by 0.75, in each case you're multiplying the discount factor by 8,000. It'd be somewhat more efficient simply to multiply 8,000 by the total of those discount factors. Well, fine, unless we had to sit down and list them all and add them up. But because it's something that happens reasonably commonly, an equal amount each year, we are given a second set of discount tables, the annuity tables, which give you the total discount factor for any number of years, from 1, well, on the tables, up to a maximum of 15. So instead of giving the discount factors for each year separately, which is what the present value tables do, the annuity tables are giving you the totals of the factors. And so we may as well make use of it, and much quicker, for example 4, would be to say, okay, there's an outflow, a cost of 45,000, and then instead of writing 8,000 a year down 8 times, we say, well, it's 8,000 per annum from years 1 to 8. That's a sort of shorthand for it. That's a short way of writing. It's 8,000 in 1 year, 2 year, 3 year, and so on. When we come to discount at 15%, 45,000 discounts to 45,000. But the 8,000 a year, again, instead of multiplying each year separately by each year's discount factor, the tables, the annuity table, gives us the total of the discount factors. Here we want 15%, so the 15% column. We want the total for 8 years. If you look at the 8-year row, it's 4.487. Now, you can check that yourself if you want. If you turn to the present value table, where you've got the individual factors, so 1 year, 2 year, 3 year, up to 8 years, add them up, and you'll get 4.487, subject to rounding because the tables only go to 3 places. But as a result, the present value of the inflows, the annuity, I get to be 35,896. And so the net present value is minus 9104. And of course, because it's negative, we'll reject. Had it been positive, we'd accept. So it makes things quicker. You can only use these factors when it's an equal amount each year. If the flows are changing each year, then you have to discount each one separately, as we did before. There's just one thing to be careful of, that the annuity factors are giving you the total from year 1 to anything. Look at example 5. In example 5, the cost of capital is 12% per year. What's the present value of 20,000, first receivable in 4 years' time, and thereafter each year, for a total of 10 years? So there's a slight problem here. There's, sorry, we don't want an NPV, it just says what's the present value. There is an annuity in that we're receiving 20,000 for a total of 10 years, but the first receipt is in 4 years' time. And when's the last receipt going to be? Now be careful here. I know it sounds silly, but I always use my fingers, because it says there are going to be a total of 10 years. So we receive it in 4 years' time, 4 years' time, 5 years' time, 6, 7, 8, 9, 10, 11, 12, 13. The last receipt will be in 13 years' time. You know, a lot write 4 to 14, but it's 4 to 13. 4, 5, 6, count up to 13 is 10 years in total. It's 20,000 per year. So again, we have an annuity and we want to discount it at 12%. But as I said a minute ago, the problem is that in the tables, the annuity factors are only giving you the total factor for 1 to anything. And so what we have to do is this. We can get the total for 1 to 13. That's the 13-year annuity factor. Now from the tables, 13 years at 12% is 6.424. But that's giving you the total of 1, 2, 3, 4, 5, up to 13. We only want the total from 4 to 13. Well, 6.424 is the total for 1 to 13. To get the total from 4 to 13, we need to subtract the total for 1 to 3. If we remove 1 to 3, we're left with the total for 4 to 13. And how can we get the total for 3 years? It's the 3-year annuity. And again, from the tables, 12% 3 years is 2.402. Take that out, and what are we left with? 4.022. That is the total for 4 to 13. And so the present value £84.40. So watch for that. Again, if you do have an equal cash flow, make use of the annuity tables, but watch for a flow starting late, as it does here. The other bit, though, is what we call a perpetuity. And what a perpetuity is, it's what you might call the ultimate annuity. It's where you've got an equal cash flow each year. But instead of being for 5 years, for 8 years, for 10 years or whatever, it's an equal cash flow each year forever. Now, of course, nothing in this world is forever. But what we're talking about is an equal cash flow for so long, as you know, it may as well be forever. Look at example 6. A machine costs 100,000 and is expected to generate 12,000 in perpetuity. So again, the way we write it, the cost, there's an outflow of 100,000. We then get inflows of 12,000 per year. But as I've just said, instead of it being 1 to 5, 1 to 10, it's forever. It's 1 to infinity. The present value, well, 100,000 discounts to 100,000. But the perpetuity, well, of course, you could do each flow individually, do it for 1 year, 2 year, 3 year, 4 year. And you'll find, you know, when you're getting up to 20 years, 30 years, 40 years, the discount factor gets so small it effectively disappears. But that would be ridiculous. You couldn't have that in. It is an annuity, but of course the tables only go up to a maximum of 15 years. That doesn't help. This is the one place you need a formula. I'll justify the formula after, but the discount factor for a perpetuity we multiply by 1 over R, where R is the interest rate. And so here, what is it? The cost of capital is 10%. We multiply by 1 divided by 0.1. As always, we write it as multiply by the factor, but multiplying by 1 over 0.1 is the same as dividing by 0.1. The present value, 120,000. The net present value, 20,000. We'd accept it's positive. So that's the one bit of learning here that you must. I mean, perpetuities actually are rare in the exam. They certainly can be asked. And it's the one place you can't use tables. You must learn that the factor is 1 over R. Now, the logic behind it is, suppose you and I, whoever's watching this, are married, but we've just got divorced. And the courts have said, I've got to pay you 12,000 a year as part of the settlement. Well, I don't want to have to keep contacting you to give you 12,000 a year. Maybe, though, I've checked with the bank are paying 10% interest. So instead of keep having to think about you each year and pay you 12,000, I am going to put 120,000 in the bank. If I put 120,000 on deposit, it will, at 10%, it will generate 12,000 a year. And I can then forget you completely. You're getting the 12,000 a year. I just paid one amount of 120. That's the logic. We've just done it backwards. I want to have 12,000 a year. We know interest is 10%. That would mean putting 120 in the bank. Finally, for exactly the same problem as we had a minute ago with annuities, 1 over R is the discount factor. but only when it's 1 to infinity. It's the total factor for years 1 through to infinity. Look at number 7. The rate of interest is 5%. This one wants the present value of 18,000 first receivable in 5 years' time, and thereafter annually in perpetuity. So it's 5 to infinity. It's 18,000 a year. We want the present value at 5%. Now, in fact, there are 2 ways you can get the same answer. I'll do it both ways. They'll both give the same answer, apart from rounding. One way is exactly the same way as we did with annuities. To say, well, to get the total for 5 to infinity, we need the total from 1 to infinity, less the total for the first 4 years. If I take off the total for the first 4, we're left with the total of 5 to infinity. Now 1 to infinity is 1 over r, which at 5%, 1 over 0.05, which is 20. What's the total for the first 4 years? It's the 4-year annuity, which from the tables, 4 years at 5%, the annuity factor 3.546, which, taking that out, leaves us for 5 to infinity of 16.454, which therefore gives a present value of 296,172. I said I'll show you 2 ways. It's really, whichever you find most obvious. For most people, I think what we've done there is the quickest. The alternative, though, is this, is to say, if it was 1 to infinity, we multiply by 1 over r, which is 1 over 0.05, 5%, which is 20. So if I multiply by 20, had it been 1 to infinity, that would give me the present value. However, ours isn't 1 to infinity, it's 4 to infinity. It's starting 3 years late. Instead of starting in 1 year, was it 4 to infinity? Sorry. Yes. Instead of starting in 1 year, sorry, I'll interject. I beg your pardon. Had it been 1 to infinity, multiply by 1 over r, but this one is not 1 to infinity, it's 5 to infinity. The perpetuity starts 4 years later. It starts in 5 years' time instead of in 1 year's time. And so whereas, had it been 1 to infinity, multiply by 20 and we get the present value, if it starts 4 years late, multiplying by 1 over r will give us a value 4 years late. And so to get to time 0, we then need to multiply by the ordinary 4-year present value, 4-year discount factor, to get back those extra 4 years because it started 4 years late, time 5 instead of time 1. And so the ordinary factor from the present value tables, 4 years, 5% is 0.823, giving a total discount factor 16.46. And what did we get before? 16.454. The difference is irrelevant for the exam, but arises simply because all the factors are rounded to 3 decimal places. So it doesn't matter which approach you take. As I say, for most people, I think they find the first approach more obvious. If you're happy with that, fine. On the other hand, if you find the second approach more obvious, do it that way, it doesn't matter. All right, well, as far as discounted cash flow calculations are concerned, that is all what you might call the mechanics. It's rare you get perpetuities. Most of the time it's either individual flows, we use our present value table to discount, occasionally annuities, use your annuity table, and of course making sure that you can calculate an internal rate of return.